You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Bupp here with episode number 172 of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate expert and distressed note investor David Van Horn. And in today's show, we're going to not only dive deep into Dave's business, but also cover everything regarding the note buying business, including raising private capital to purchase distressed notes, what type of notes Dave likes and why, the many ways to make money as a note buyer, how to build relationships with the bank's asset managers, how to work with borrowers to modify their loan terms, how to evaluate defaulted second mortgages, working through the foreclosure process on your note, getting set up with a loan servicing company, what to do with any duds or bad notes that you might end up buying, how to get started, and much, much more. So I'm very excited to get on to the show with Dave, but before we do, I have a few important items to go through quickly with you guys. First and foremost, for those that are just joining us for the first time, I want to thank you for joining in and just wanted to share some basic information about us and what we do as a company, our company. We specialize in mobile home parks. So today's guest, we're going to be talking about distressed notes. But my business is mobile home park investing, and I'm only telling you that because we are actively seeking more mobile home parks to purchase. We're in buying mode. We're always in buying mode. And so if you're out there on the hunt looking for distressed notes, or looking for other types of opportunities, whatever niche you're in this real estate world, if you run across a mobile home park that is 60 plus spaces in size or larger, and it's either something that maybe you're looking to potentially take down on your own, but maybe don't have the track record or all the capital to do it, we'd love to speak with you about a potential joint venture opportunity. Or if you'd like to just take it and flip it to us, we'd love to pay you a big fat finder's check as well. So if you have something that looks like it might be an opportunity, you want to chat about it, shoot me an email to kevin@kevinbupp.com, and I'd love to discuss it in further detail. We can handle deals as large as $25 million. They can be single deals. They can be portfolios. Really, the sky's the limit. So if you run across something that seems very interesting and intriguing, please think of us. Again, kevin@kevinbupp.com. We actually have 2 deals in contract right now as I actually record this podcast that we are prepared to pay close to $200,000 in referral fees on. So how would you like to have another $200,000 in your pocket? Pretty cool, huh? Well, shoot me an email if you have something to talk about. Next up, guys, I just wanted to provide an update regarding our mobile home park fund. If you are a regular listener, then you'll know that we just recently closed out our first successful Reg D 506C offering, and couldn't be happier, both with the parks that we purchased in that fund, as well as the many different investors that we've had the opportunity to get to know and also partner with on this first fund. Well, unfortunately, with the good, there was some bad, which means that there were a number of you who had shown an interest in partnering with us, but were not able to get into that first fund prior to us closing it down. But no need to fret, because we are coming out with Mobile Home Park Fund number 2 here in the coming months, and expect to really have it ready to roll out by like the middle of Q2. So if you missed out on that first fund and have an interest in partnering with us on that second Mobile Home Park Fund, please be sure to go to our website, sunrisecapitalinvestors.com, and create a free account inside our investment portal. This will basically place you on the first to know basis when our second fund rolls out. So I'm guessing that based on the demand for that very first fund, we're expecting those subscriptions to fill up very quickly. So go create that free account. Literally takes you less than 5 minutes. sunrisecapitalinvestors.com, and we'll look forward to chatting with you. Lastly, guys, if you happen to be in the Tampa Bay area, if you're here just for work, pleasure, whatever it might be, and you got some extra time, would love to meet with you, buy you a coffee, buy you a beer, buy you lunch, whatever you have time for. So shoot me an email, again, kevin@kevinbupp.com, and let's see if we can coordinate our schedules when you're coming to visit. I live in Clearwater. I'm about 25 minutes away from the Tampa airport, and would love to have the opportunity to meet with you and just talk shop. So whether you're brand new to the business or you're a seasoned investor, I love meeting others who share the same passion for this business. Now, guys, let's get on to the part of the show that you've been waiting for, which is our interview with Dave Van Horn. So here we go. All right, guys, today on the show, we're thrilled to be joined by distressed note investor and fund manager Dave Van Horn. Dave serves as president of PPR, which is a note company that manages several funds that buy, sell, and hold residential mortgages nationwide. His expertise is derived from over 30 years of residential and commercial real estate experience as a licensed realtor and a previously licensed life and annuity insurance agent before moving on to raising capital for commercial real estate deals. In addition to his activities with PPR, Dave is also a board member and facilitator for Strategic Investor Alliance, which is a networking and educational group for accredited investors. So without further ado, let's welcome Dave Van Horn to the show. Dave, how are you doing today?
Great, Kevin. How are you?
I'm doing fantastic. Looking forward to having you on the show and digging into the note business that you're a part of. And before we dig into the note business and talk about that, what I'd like you to do, Dave, is I'm going to pass the mic back to you now. If you could take a few minutes and tell our listeners a little bit more about yourself, maybe expand on that background I gave you, and what you did before the note business, kind of how you got into it, and then what you're up to today.
Wow, I got it.
Yeah, I know that's a lot.
I started in the fourth grade. No, actually, got into the note business by accident. So I, when I first got out of college, I went to college to be an accountant, and I hated accounting and switched to management. Got out of school and couldn't get a job. So there you go. And I was working in construction, and my mom convinced me, why don't you go get your real estate license? And that's what I did. And in the beginning, I didn't have any capital. So I literally started buying houses with credit cards. And I would buy a house with a credit card, fix it up with a credit card, move a tenant in, refinance the house, pay the credit cards off, and basically get not a free house, but you get the idea, get all my money back. And I built a whole portfolio of residential properties. And then eventually the market jumped up and I had a couple $1 million in equity. And then I started using lines of credit, the equity, at first to go buy more properties. But then I started getting into private notes where I would do like hard money deals for guys, other contractors. I would lend them money off my lines of credit, from my apartment buildings and things like that. So that's kind of how I started into notes. But fast forward, as I became a real estate investor, I was working at a Remax and I was like a property manager. And so I only sold to investors after several years in the business. I kind of focused on a niche area of just investors. I owned my own title company, that kind of thing. So I would sell you a property, get the title business, get the property management business, and then, sell you multiple properties and re-rent them and all that kind of thing. Mm-hmm. But as time went on, I was doing this note thing, this private money thing, like a hard money lender. And I was like, wow, this note thing's much easier than these tenants. Because real estate's great if you didn't have people. Wouldn't it be phenomenal? But so I was starting to lean towards easier ways to do business, right? So I was like, I started to get into commercial real estate because I was like, well, I only have a tenant from 9 to 5 instead of 24 hours a day. Or, in the beginning, I was, I was getting into mobile home parks and storage centers. And I started raising capital for that with a company out of New Jersey. And they kind of taught me a lot about raising money, which was great. And what we had done was they had bought a total was about 8 mobile home parks and a couple storage centers with none of their own money, which was interesting to me. And then I started raising money for some new construction up in the Lehigh Valley, which was commercial office condominiums. So I was used to raising this money, and I was running a local real estate investment group, and I used to interview the speakers. And we had a speaker come down from Manhattan, and they were raising capital to buy pools of delinquent mortgages. And I was like, yeah, that's neat and all that. And I didn't do anything, but I had a partner who did. And he was always getting paid a real good return. And we're like, how are they doing this? And then when, I guess it was like 2007, we were like, well, the real estate market was starting to tank, especially in the residential sector. And we were like, hey, what are we going to do? My one partner was a mortgage loan officer. And we go, hey, let's talk to our buddy up in New York and see if he'll, sell us delinquent mortgages and show us how to work the business. And that's what he did. He showed us the collection side of delinquent notes. And we started out buying loans from him. And one thing led to another. And here we are today, several years later, and still in the space and loving every minute of it. So.
So when you say you're buying delinquent notes, I mean, are we talking like you're buying individual notes? Or are you buying these things in bulk at a time?
It's a little of both, but most of it's really how are they selling them. Some banks and servicing companies will sell where they'll allow you to cherry pick loans, and then some make you take, we call it the baby in the bathwater. You have to take everything. So we see both, and you have different strategies when you're buying that. Initially, the interesting thing is when we first started in the business, we specialized in delinquent second mortgages, which when you tell people that, at a cocktail party, they're like, what? You invest in delinquent upside down second mortgages with no equity and in bankruptcy and all this kind of stuff, and people's heads come off.
Yeah, my head's coming off right now. How do you make money on something like that?
Well, I got news for you. If you can make money on that, you can make money on anything, right? So it's and then later on, as we grew as a company, we needed more consistency of deal flow, and obviously the first lien market's a much bigger market, and there's a lot more product and consistent deal flow. So we're in both spaces today. We only to your point earlier, we only focus on 1 to 4 family residential. We really don't focus on like vacation homes or commercial real estate, although there are outfits that do. Like I'm in the Philadelphia area, there's a very large fund in town. It's like a $2 billion fund, and that's all they do is commercial notes,
Mm-hmm. What's the reasoning behind that? Why do you focus on the 1 to 4 family residential versus commercial?
For us, it's risk. It's funny when they used to say that to me about the second liens. They go, why do you invest in second liens and not first liens, years ago? And we were like, because first liens are too risky. And they would look at you like, you had 6 heads. They're like, what do you mean? But they're just concentrating in their mind. It's all about lien position. But to us, it's more money into a deal and more risk in that deal. So it could be a function of how big you are. We're a smaller specialty servicing company, right? So we don't have as much capital to deploy as Wells Fargo or something. So it's a lot depends on your size too. But if you think about it, like a large commercial deal, you don't have a lot of room for error, right? You better be good on your numbers of value and renovation and holding time and cost of capital, because all your eggs are in that large basket. You know what I mean? Especially if you're buying, a real big apartment complex or a big student housing piece or something like that. You got a lot at stake in that one deal. Whereas if I have, 50 first mortgages spread out throughout the country in multiple markets, my risk is kind of spread around, right? And same way with second mortgages, you can buy a lot more second mortgages for the cost of a first, and you can, diversify your risk throughout the country type thing.
Okay, gotcha. Well, since I'm somewhat of a neophyte at this business, I mean, I've never purchased a distressed note in my life, and I've done hundreds, if not, in the thousands of real estate transactions since I've been in this business since, I guess, 1999 range. And I've never gotten into the note side of the business. I tend to stick with what I'm good at, and today that's buying and operating mobile home parks across the country. And so I tend to try to be an expert in one thing, just like you're an expert in the note business. And so I've never really ventured down this path. And so what I want to know from you, Dave, and I know there's probably multiple different business models that go along with this note business, but I want to talk about your business model today and understand a little bit more what that looks like. So maybe walk us through kind of step by step what your normal note purchase looks like, and then how you guys make money from it. And I'm assuming there's probably different profit centers there. There's probably different methods of due diligence before you guys purchase a note or notes. So maybe walk us through that if you would.
Well, first of all, what I do, my main role at the company is, one of them is raising capital. So I manage a lot of our funds, and I go out and raise money from high net worth people. And my partner, John, he actually runs a data team, and he oversees operations. And what they do is they do all kinds of analytics. And really what it comes down to is we have collection data that banks don't have. So like banks don't know the collectability of delinquent assets necessarily, because in their world, it's a small percentage of their portfolio. In a good market, they might have 1% of delinquent loans. So they're really in the lending business. They're not in the collections business, just like they're not in the real estate business. So my partner, John, he'll do all kinds of analytics on a tape of mortgages, which is really Excel spreadsheet with a lot of data on it. And they do a lot of analysis, everything from trying to determine fair market values and equity positions, as well as courthouse data. So I'll give you an example. We have software people that will actually write software that could do web scraping, that could read 10,000 credit reports in a day, almost like a human was reading them. The software will read through the credit reports and kick out assets. And they do the same thing on government websites like Pacer, which is a public records bankruptcy type site, where we can do web scraping and analyze assets that way. And what happens over time is you have this data becomes like the DNA of your business. And we pretty much know the outcome of a pool of loans prior to buying it. So when they first see a tape of loans, they analyze it to say, hey, what is this? And then it's on historical data that we have, what's our collectability? What's our recoverable of this pool of loans? So it is pretty neat that over time you're able to do that. Now, in the beginning, it's a dart throw, and that's the price you pay to get into the game, right? You have to. It's kind of like a learn by doing business. You have to jump in there and work the assets and see how you can collect. So once my partner John makes a purchase, we bring in the assets. We go through all the collateral files to see what's there, do an inventory, that type of thing. And you can outsource those types of services as well. And then once these assets come in, they go over to I have a third partner, Bob, who oversees our asset managers. And they're the folks that smile and dial to the borrowers. And we're able to do some things that sometimes banks can't do because we have a lower price point that we got into the asset.
Right.
So you can... we can do modifications and things like that are maybe harder for the bank to do. But it's a different conversation, though, than the bank. Because a lot of the banks are more of a pay up or get out mentality, unless the government's putting pressure on them to modify or something. But ours is more like, what happened? Where are you at now? What would you like to do? Let me help you do that. And then meanwhile, legal's moving forward. So we do work with a lot of law firms throughout the country. So we have a pretty good network of law firms. Legal is probably our biggest expense.
Okay.
And then,
so I'm assuming.
Yeah.
Oh, go ahead.
So once the asset managers, typical asset manager might have 200 to 400 loans, depending on the asset manager, and we have support staff, that type of thing. And then they go through. Typically, they'll talk to a borrower and go through stories of how they help different borrowers in different parts of the country, and they'll say, "Does this fit you? Does this fit that kind of thing?" So they don't tell them what to do; they just give them ideas, and then it's really up to the borrower to create their own plan with the asset manager, if it's going to stick. And then once these loans are modified, a lot of times we sell them off to real estate investors. So we teach the collection business and that kind of thing too. So.
Okay. So I'm assuming that there's probably 3 different scenarios that might happen after you purchase a tape of notes, and those 3 scenarios, and correct me if I'm wrong, would be there's going to be some duds with the good ones as well, right? You're going to find that there's going to be some that just aren't collectible, and they're going to be they're not throwaways because you probably still sell those off at a discount. But so there's going to be the ones that can't be modified, or that just maybe it's just it's an asset that it's a note that's in an area that you guys just really could care less for. There's really no desire, and you just maybe overpaid for that particular note when you bought that batch. Whatever the case may be, it's somewhat of a dud. And then there's going to be the other ones that you can get a modification done with. They want to stay in the home. Your asset managers are able to work out a scenario with them that makes sense for everyone. It's a win-win. And then there's the other ones that probably are stubborn, don't want to do a workout, and you guys have to foreclose on them. So are there more instances in that can come up, or is that the primary 3 that you guys deal with?
I wish there was only.
Yeah, there's a lot more?
So okay. I'll give you an example. In second lien world, there's probably about 18 different categories of assets, but there's probably there's probably 6 main categories, and a lot of it's based on equity and senior lien status, for example. So based on the equity position and the senior lien status, you'll start to be able to predict statistically what would happen. So with second liens, everything's very statistical, and it's because you're exiting through the borrower. Now with first mortgages, you're typically exiting through the property. So now it's almost like a different philosophy right out of the gate. So when you're buying first liens, we almost look at it identical to like I'm buying properties. You have to almost look at each individual asset because you're buying each property.
Sure.
Mm-hmm. And then BPOs and boots on the ground to go out and look at estimated repairs, that type of thing, become a lot more valuable with first liens. And with first liens, you're a very geographic buyer. In second mortgage space, you're really only geographic if it's a high equity, expensive second lien. If it's like a low equity second lien, well, you're not even concerned about value as much. You might even pull electronic values. Like upside down seconds, I don't really need an accurate BPO to tell me it's upside down. I already know it's upside down when I bought. You know what I mean? It's like, but then again, your risk level's different. So I'll give you a good scenario. Some folks would say to us, "Do you buy loans in Detroit?" Well, if it's a high equity second, I'm more concerned about geography. Then I'm more concerned about value in the neighborhood in, say, Detroit. But if I'm buying a second lien that's upside down and delinquent on the first, well, I might not care if it's in Detroit, but then again, I might have only paid, $80 for that loan too. So you got to put it in perspective, kind of thing.
Okay. Are you guys finding it a little bit more challenging to find these big tapes of distressed notes, being that there's not as many foreclosures, or what's the outlook of your business at this point in the market cycle?
Yeah, it's an interesting question. We get it a lot. We're constantly bidding. We're constantly seeing assets. And there is a lag. There's probably a 3 to 5 year lag of delinquent debt. So that does happen. And you'll see where, the amount of seconds, for example, could start to shrink because they haven't really been writing a lot of seconds. Mm-hmm. But we have loans that are 10 years non-performing too, Wow. I just saw some first liens that hadn't been paying since the early 2000s. So it's,
oh my gosh, that blows my mind
that these assets still sit out there. Now, what happens is it's like any parts of real estate. You have an up market and a down market. The way you make money shifts, and in our business, it's more of a like a time for money equation than it is just supply and demand. Obviously, when supply shrinks, the cost goes up. But a lot of it has to do with equity in the marketplace. So when we started out, it was an up market. There was equity in the marketplace. And then we went through a crash where, the equity fell out of the market. That was more scary than where we're at today, I think, because we're headed back to where equity comes back in the market. Because when equity comes back in the market, our whole portfolio goes up in value dramatically.
Sure.
And sure, the cost of assets go up. But I'll give you a couple scenarios, for example. We might have a loan that, we paid, $5 or $10,000 for in a down or flat market that might have had a balance on that second mortgage of 40 or 50 grand. Well, you could contact a homeowner and, maybe you modify or you do a discounted payoff at, say, 20 grand. Well, in an up market, I might pay 30 grand for that $50,000 payoff. I can't discount as much. Now, in an up market, I'll get out of deals quicker. And if I take a property back, and even if I don't sell it this week and I sell it next week, well, it just went up in value because it's up market, right? In a down market, it just takes longer to exit and there's fewer options. Like in a down market, you won't see much deed in lieu, for example, whereas in an up market, you would. So it's your strategies and your exit options can change a little bit depending on whether it's up or down market. But it doesn't mean you're not making money. In an up market, you're making money quicker. In a down market, it's taking you longer. So
sure.
That's what I mean by the time for money thing.
Okay. And you said that you guys do sell a lot to investors on the back end, but I'm assuming that you also have your own portfolio that you hold as long-term notes as well?
Yes, we do all the above. Primarily, I'd say the majority is sold, liquidated, because it would be like someone buying a house, renovating it, and selling it, or you buying a mobile home park,
sure,
turning it around, raising a lot rent, and refinancing it out and taking out the investors. We kind of do the same thing. We manage several funds, and our goal at the end is to pay back the investors as quickly as possible. And then in the end, me and my partners own the assets remaining in that fund, right? So.
Gotcha. Okay, sounds good. Well, I'm assuming that a big part of this business has got to be the relationships, right, with these asset managers of these banks and financial institutions. And I'm assuming that's probably one of the biggest barriers to entry of actually getting in this business and being successful with it. I mean, would you agree or disagree to that?
Yes, it's all the above. It's track record, it's reputation, it's performing, when you're supposed to close, and if you don't close, you could be blacklisted. It's having the capital. After a while, companies get reputations, that type of thing. But it's also compliance too. So a lot of the larger banks and servicers, they only want to sell to a compliant note buyer. So it's a very different world today. Whereas in the old days, you could pretty much sell a note to anybody and that type of thing. Whereas today, like, for example, we won't sell a note unless you had a licensed servicer to receive the note at the other end. We wouldn't even sell it to you, you know. So from the compliance perspective, it's a little stricter today than it used to be. It used to be a little bit of the Wild West, and that's kind of changed over the last couple of years.
So today you'd have to be a compliant note buyer, and what does that mean? What kind of training or certification do you have to go through to become a compliant note buyer?
I don't know so much that it's training. The licensing requirements can vary from state to state, but most of the time, if a note buyer, especially a smaller note buyer, if they have their assets with a licensed servicer, for the most part, that's all they really need to do.
Okay, and
that's easy enough to do. You know, that's it's sort of like. I call it like property management for a note. So they'll send out, the notices to the homeowner. They'll do the tax reporting at year end. They'll send out late letters, and they'll even foreclose too. So that's the one thing about the notes. It's a little more passive, as far as you can do everything on a phone and computer pretty much.
Mm-hmm. With the servicing companies, is there a typical percentage fee that's charged for servicing a note, or does it vary?
It might vary if it's a delinquent. Like if it went delinquent again, they might charge an uptick in fee. But most of them are like $15 a month type of fee.
Okay,
so it's pretty nominal. And what's good about that's one of the things I liked about it compared to property management. Was it's $15 a month, whether it's $300 a month in payment or $3,000 a month in payment.
Yeah, that's nice.
Yeah, so.
And then I'm assuming if that thing becomes delinquent or a borrower misses a payment, they have to send out notices and things like that. Those are probably additional a la carte items. I mean, if there's postage and letters and things of that sort that have to be sent on your behalf. Okay, sounds good.
That's correct.
All right, so. Someone new getting into this business, again, I told you I knew nothing about this business. So if I was saying, hey, Dave, I'm interested in this business, I want to get involved, I mean, what are the steps that you would tell someone new that wanted to explore this business a little bit more?
Well, it's a couple things. A lot of times I'll send somebody, I have an ebook out that's Intro to Note Investing, so I usually send them an ebook. In fact, if you go to our website, pprnoteco.com/intro, you can actually get a copy of the ebook. And it's an introduction to note investing. But it's really like anything new that you go to do. I have a son that's a script writer in LA. And when he first moved to LA, he's like, Dad, what should I do? I said, well, you want to network with people doing what you want to do, right? And you want to get educated in the space, obviously. And it's those types of things where, partner up with somebody doing the business, that type of thing. So it's, I think that's important anytime you want to, join a community of other note investors, and network with those folks, as well as, getting educated and then take action, go in and invest in a note. Like I said, I started out in private notes with hard money deals, and it was a great way to, just initially get into the note business. A lot of times people start out with performing notes because you don't have to know a whole lot. And we do that too. Like we give people, a performing note guide and there's not much to do when the note's paying. My 84-year-old mother has performing notes, and she's like the note queen. And
that's great.
She still wonders that you can do this. She might say, "Is this legal?
Is this legal, Dave?"
That type of thing. And but yeah, I mean, I tell people, when they first ask about notes, because their next door neighbor might not be doing notes, so is this real? Can you do this? But when you really think about it, everybody's in the note business already, right? We all have credit cards, student loan, car loans, medical debt, and when you really think about the amount of debt in the United States, there's it's $1 trillion industry where there's all types of debt out there, and we just happen to like secured debt, which I do like this space, and I like real estate because of my background's real estate. So it's something that I can get my arms around, and I like that it's scalable. If we own thousands and thousands, well over 5,000 or 10,000 loans at any given time, if I owned, 5,000 properties, you can imagine the amount of work you would have to do. I'm not saying you can't do that, but you get what I mean. If you had 5,000 units, you definitely need a lot of support, right? Whereas if you have 5,000 loans, it's somewhat more scalable, if that makes any sense. And
sure, absolutely,
can be managed more with software and things like that. I'm not, of course you need help to do it, but you get the idea.
But a lot of the grunt becomes, after you actually purchase these notes, a lot of the grunt work after your asset managers have talked with these people and you've decided what the game plan is for that particular note itself, the servicers kind of take over a lot of the day-to-day type stuff, I'm assuming, right?
They're the ones that are... You, like us, it depends. Like I look at it this way, there's two ways people go at the note business. They could go, well, I'm an investor in notes, or I'm trying to run a note business. Well, they're two different things, right? Like my business is a saleable business, whereas I could be Dave, the note investor, where I have a portfolio of performing loans, which I do, by the way, but you get the idea. That's it, and there's nothing wrong with either. They're just different. Sure. So if you want to go down the business route like we've done at PPR, well, then now you start to get an economy of scale with administrative stuff. That, like, we have girls that just do recording of assignments all day long, or servicing setup all day long, or we have an REO department. Whereas an individual investor is not going that far with the. He'll outsource more than we will.
Okay. What does your actual team structure look like? Do you mind sharing that with us?
We pretty much have 3 divisions. I oversee, like I said earlier, investor relations, and I also oversee marketing and sales of individual assets on a retail. So we're like a wholesale to retail shop. Okay. My partner, John, who oversees operations, we also have a trade desk where we'll sell assets off to people. Like we'll buy non-performing and sell non-performing too, that before they even hit an asset manager. And then, so the second division is my partner who does all the analytics and all the acquisition and all the operations. And then my other partner oversees all the asset managers and all their support staff. So it's really 3 divisions in the company, the way we're set up now. Well, the 4th division would be admin. We have a girl that oversees all the admins, so it's really almost like 4 divisions, and that's it pretty much.
Okay. And I'm assuming you probably have different funds for different type of acquisitions. So, but can you give me a general idea of what kind of target returns you guys are looking for from these fund acquisitions or these note acquisitions?
Well, most of the most of the returns we've paid out to investors, we've had preferred returns anywhere from over the years between 8 and 21%, which is a pretty big gap. But a lot of that depends on the market, and it depends on what type of assets that fund buys. Sure. So some of them are first lien funds that are, in the 8, 10, 12% ranges, whereas second lien funds are in the higher rates sometimes depending on the market. So, but as far as the funds make, we don't share upside with the investors, but it's higher than that.
So they're strictly debt funds?
Yeah, so it's higher than that, obviously.
Okay. Yeah. Okay, so they're strictly debt funds then that you have.
Well, we're all equity, so they're all equity investors, but it's similar to that in that regard because the preferred return almost feels like interest to the investors. Where
sure, yeah. Okay, good deal. Well, I don't want to digress here from what we're talking about, but in the beginning, when you're just kind of telling your story a little bit, you had mentioned that how you got into this business. You first started buying houses, and you're buying with credit cards. So I wanted to hit on that, and I forgot. So I'm going to go back reverse a little bit because you're based in the Philadelphia area, and I want to know what those homes look like that you were buying with credit cards. Because I'm assuming you're talking like dilapidated, scary neighborhood type stuff, right? Or
to be quite, not so much scary.
Unless you've got like $100,000 credit limit on your card, and that might be the case. But in my mind, I'm thinking like $5,000 and $10,000 row homes that are.
No.
Okay.
Most of what I was buying was probably in the. Yeah, you're kind of right. Between 10 and 20,000, 30,000, and they might be 50 to 70 fixed up at the time. You got to realize I started buying in 1989. Okay. So some of it was a while ago, but you are correct. I liked areas that weren't in war zones, so I was usually in, blue collar areas, that type of thing, and you had more renters and
because I've bought homes with cash advances on my credit cards back when I was getting started, and we were buying. I mean, I was in Harrisburg, so we were about 2 hours away from you, but a lot smaller city. But we were buying in somewhat rough. I mean, I wouldn't call it war zones, but definitely an area that me being a white guy, probably wouldn't go to at 1 o'clock in the morning. Right. But I was buying homes for $6,000 and $7,000, and putting another 10 into them, and they would be worth 50 or 60 grand. But they were, again, maybe not war zones, but somewhat scary if I'd be stuck there stranded at 1 or 2 o'clock in the morning. So I didn't know what exactly you might have been buying. Well, good deal. What else do we need to know about the note business for those listeners that are tuning in that, again, have an interest in potentially exploring this road? And I know that you offer some trainings and things like that. So would that be the next step for someone that has an interest in this business? I mean, you have an ebook that they go download. What else could you tell us that would be a good stepping stone for them to take if they have an interest in moving forward?
Well, I mean, here's the way I kind of look at it. And I run an investment group, Strategic Investor Alliance is a group I run. And the way I look at the note business, and I'm honest with people, it's just one vehicle of many. So I kind of look at things, maybe it's because I had done financial planning for a short period of time. I kind of look at it as just one tool in the toolbox to building wealth, and one of the premise of our investment group is to, share, build, and preserve wealth. And when you really think about it, I love, because sometimes people will say to me, well, you're the note guy, you don't like real estate, or like, where do you get this from? I have plenty of real estate. I'll always own real estate. It's just one pillar, so to speak, in my wealth building. I wish it was a fortress, but you get the idea. So I think it's many things. I have a lot of different types of funds I run, and they're not all note funds. And I also so I like having my real estate. I like having my insurance contracts. I like having my IRA accounts. I like having my note funds and my note company and my, what I mean? So it's just one more bucket of, potential wealth building is the way I kind of look at it. So it's just one of those things. The reason that, I like it, there was a time in my life where I was like trading options, for example. But the one thing I like about this space is I can buy it at discount with a high yield, and it has collateral. So that's what really sells me on it. And the fact that I can scale it and it's not as much touch, whereas the actual hard residential real estate was a lot more intensive. And you're right. Like today I have a property manager, and years ago I was one. So that was a hard person for me to hire. But it was the smart thing to do because, what's a property manager worth? I'm better off doing what I do today than actually managing the properties myself, right? So it's the same idea, but, and you can do the note business the same way. You can outsource any part of the note business, which is great. And the fact that, like I said, you can buy it at discount with a high yield with collateral. And when you factor in on top of that, it's 1 to 4 family residential. Those folks have a vested interest in that property, in that collateral, because everybody needs a place to live. When you look at, Maslow's hierarchy of needs or whatever. So you're kind of investing in a unique product in my mind. And that's what I like about it. Now, doesn't mean what everybody else does is bad and what I do is the best or anything like that. But you get the idea. That's why I like that investment vehicle.
Okay, I'm assuming that a majority of your note acquisitions are single family, and then there's a small portion that make up to 2, 3, and 4 family. Is that a valid statement?
Yeah, I mean that can happen, and sometimes you'll even see where a family that couldn't hold on to the property tried renting it out too. So they just, I can't afford it, I'll rent it out and keep the rent and move on and not pay the mortgage or whatever. So you see all kinds of things. But for the most part, they're 1 to 4 family, and they are, a lot of them are owner occupied. With first liens, the borrowers tend to be more banged up financially, though.
Interesting. Yeah. Okay. Well, Dave, I'm going to ask you a tough question now. Okay, I'm going to put you on the spot a little bit. If you can go back to year 1 of your own personal career, right when you were getting started, and knowing what you know today, and give yourself some advice, what would that advice be?
Well, there's a couple things I think of. One is control. Like the only time I ever lost money was when I gave up control of my money. That's one lesson.
And what does that mean? How did you give up control?
Well, I would invest in an investment vehicle where I wasn't running the show or I wasn't involved in the management. Like I was a passive investor.
Okay.
And then I might have, because I can't jump in and fix it, right? But I think it's kind of like helping others get what they want, and you'll get what you want. I think it was, who was it? Zig Ziglar said that.
Absolutely.
So I think it's kind of like the more people we help, the better we all do, kind of thing.
Okay, good deal. Well, Dave, now that this is kind of where we get to the end of the show, this is what I like to call our Golden Nugget segment, and this is where we round things out. But before we say goodbye, what I'm going to ask for you to do is, if you could leave our audience with one last piece of advice or wisdom that may inspire and help them as they progress in their real estate investing career, what would that one last golden nugget of advice or wisdom be? And this could be your favorite motivational quote, maybe some core principles that you live by, whatever it is. Just give us that one last piece of wisdom or advice.
Well, I think honesty and integrity is a tough one, but I know when I've raised a lot of capital, and I know one of the things a lot of investors forget is the money list, right? And I think the money list is just as important as the buyer's list or the deals and all that kind of thing. But I also think it's having a coach. I've done really well being a member of CEO groups and hiring consultants, and I've had a coach for many years at different types of coaches over the years, but I've always had a coach, and I think that's really helped a lot.
Mm-hmm. Absolutely. It helps you accelerate your path of growth, and it helps you avoid the mistakes. Find someone that's an expert at doing what you want to do, and it even offers that third party perspective that we need quite often. I love having sounding boards around me, and so I've got guys that are in my business, that are in our industry, that they're not necessarily partners of mine, but there are others that are in the industry itself, and I can use as sounding boards. I can call them a coach, call them a mentor, call them an advisory board, whatever you want to call it, but they're all very integral in my success and integral in the growth of our business. So I truly believe in that as well. And I'm a student of education, and I'm forever trying to further that education. I suggest everyone else does the same. And I get a lot of people that I get a lot of emails, Dave, through this from this podcast, that people that reach out to me that are just getting into the business, and they'll ask for recommendations for different maybe coaches or hey, have you ever heard of this person? They're offering this program, and I don't like getting involved in giving feedback based on programs, but I will tell people that if they have a trepidation because they're worried about paying for something, then they might want to find another line of work. It's really hard to learn everything you need to know without paying for education. People go to colleges, they pay for education. And, so just know that you're more than likely going to have to pay for advice or pay for a coach or pay for good education. It's just your job to filter out the good from the bad and make sure you get the right kind of education. So, but either way, well, Dave, this has been a lot of fun. I've learned a lot about the no business. Like I said, I'm a neophyte, and so everything I asked you today were valid questions that I had, because I really don't know anything about this side of the business. But you piqued my interest. That's for sure. I'm always looking for other profit centers or other revenue streams. And again, I never really went down this path, but I think I'm going to go grab your ebook. That's for sure.
No, my pleasure. My pleasure. It's fun being on.
Yeah, and guys, to learn more about Dave and his company, please go visit him at pprnoteco.com. Again, that's pprnoteco.com. And Dave, that's all we have for today, my friend. You take care, and you have a wonderful week.
Thanks much, Kevin. Take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.